All right, welcome back. This is we are still in chapter 3, and this is part 12. Yeah. Okay, we were discussing in the last clip the day sales and receivables. Yeah. All right, the day sales and receivables. How do you compute that? It is just the reciprocal of the receivable turnover multiplied by 365 days. Yeah. So therefore, or another way of doing this, you can take 1 divided by 4.33 and multiply with 365, you get 84.39. Or what you can do is, you take receivables, okay, from the balance sheet. Okay, you take receivables for the year 2018, which is 1156. Then you divide this by 5,000, which is the revenue, sales for the year. Then you multiply that with 365, so you get this value, 84.39. So how do you integrate this? What's the implication of this value? 84.39 days. So there are two ways of looking at this. So on average, this means that the company takes about 85 days, slightly less than 85 days or 84 days, to collect from their customers. Once they have sold to the customers, it takes about 84 days for the customers to pay or for the company to collect. So that's the broad implication of this day sales and receivables. Okay, so basically the longer it takes, it means that the company is less efficient in collecting from their customers. That means they hold too much receivables to generate sales. So lower this value, means the company is more efficient in collecting from their customers and also in holding less receivables to generate more sales. So that's the idea behind this. Note that these two are reciprocals, meaning that if this is high, this will be low. And if this is high, the day sales and receivables is higher, then this receivables turnover will be lower. So these are directly related. Directly here, meaning they are perfectly correlated, but they are perfectly negatively correlated. Meaning if one goes up, the other must go down. There are no two ways about this. So that is the relationship between the two. And as I mentioned earlier, with inventory turnover and day sales and inventory, even though the measure is different, they reflect the same information. Likewise, these two, they look different, right? Receivable turnover and day sales and receivables, they look different, but they convey the same meaning, or same interpretation or same information. Is that okay? All right, then we move on to the next asset management variable. Asset management ratio variable. So the fifth variable ratio here is net working capital turnover. Now the asset here is net working capital, but actually net working capital is not an asset. It is actually a combination of an asset and a liability. Current asset minus current liability. But here we treat that as an asset, like an asset. So here it is net working capital turnover. So in order to compute this, we take revenue or sales divided by net working capital, and the net working capital, you take it, you get the figure from the balance sheet, which is total current assets minus total current liabilities. So 5,000 divided by the difference between the current asset and the current liability. Therefore, you get this value, net working capital turnover. So it is 28.90. This is not in number of days. Only this is days. These two are days. Right? But this is in multiple. Meaning how many times. So the idea here is the sales generated by the company for the year 2018 is 28.90 times the company's net working capital for the year. So that's how you interpret this. Yeah. So you can interpret this as using $1 of net working capital, meaning when your current assets are $1 more than your current liability, the company can generate $28.90 of sales. Okay, that's the implication of this net working capital turnover. Alright, so that is the fifth ratio. The next ratio is the sixth ratio, which is fixed asset turnover. The book uses FAT, like fat. In other books you can books use FATO, TO for turnover and FA for fixed assets. So fixed asset turnover. So fixed asset turnover, the formula is again similar: sales divided by fixed asset. It's always sales. From here onwards, it's sales divided by receivables. This is sales divided by net working capital. This is sales divided by fixed asset, and the next one is actually sales divided by total assets. So here you take sales 5,000, divided by total assets. You can take this value 5606. Okay, so you get this is total asset turnover. Sorry, you need to go to the fixed asset. The fixed asset is here 3438. Okay, 5,000 divided by 3438, you get this value. Fixed asset turnover is 1.45. So how do you interpret this? This means that the company's sales is 1.45 times the company's fixed assets for the year 2018. Right, so this indicates, this measures sales as a multiple of fixed assets. It also reflects sales generated using $1 of fixed assets. Alright, so this is the implication or interpretation of the ratio. So generally, higher this ratio means higher the efficiency in using the asset, the fixed asset. Okay, likewise here, higher this 28.9, let's say net working capital turnover, higher this ratio means higher the efficiency in using net working capital in order to generate sales. So likewise you interpret that this in the same manner. Okay, and the final ratio for asset management ratio is total asset turnover. Alright, total asset turnover is similar. You take the sales or revenue here, 5,000, divided by total assets or total liabilities and equity. They're the same thing. So you divide that, you get total asset turnover. Note that the total asset turnover is also given in decimal. This is multiple, so 0.89 times. Okay, what is 0.89 times of what? Okay, so here the sales are 0.89 times the company's total assets in the year 2018. So that's how you interpret that. So by using $1 of total assets, the company generates 89 cents of sales. Okay, that's the interpretation. Alright, then we move on to the next category of ratio. Okay, the fourth category of ratios. These are called profitability or cost efficiency ratio. Just now it was asset efficiency before this. Now this is cost efficiency. How well the costs are contained by the firm, contained or controlled by the firm. Okay, so generally speaking, the first one, all three ratios we can call it as profitability ratios, but only the first one we refer to as cost efficiency. Because the other two ratios, even though they are profitability ratios, they have other elements apart from cost. It's not only cost efficiency. Cost efficiency is a component in these two, but there are other elements. Yeah? So as you will see later when we look at DuPont analysis. Okay, so let's look at the first ratio here, profit margin. Profit margin, the formula, okay, is net income or profit, yeah? Net profit or net income or profit divided by sales. Yeah? So you take here net income 893 divided by sales, which is 5,000. Yeah? So you get the value. Yeah? Now this is a small number. Okay, it's less than 0.8. Therefore, you express this as percentage. Yeah? So it works out to be 17.86%. Now this means that, how do you interpret this? Okay, this is interpreted in this manner. Yeah? The numerator is 17.86% of the denominator. So here 17.86, it reflects the net income. Yeah? So net income is 17.86% of the sales for the year. Yeah? Now note that this formula, both the numbers, yeah, the numerator and the denominator, comes from the income statement, yeah, not from the balance sheet. Is that okay? So that's how you interpret. Yeah? So it measures net income as a proportion of sales. Yeah? Reflects the net income achieved from $1 of sale. Yeah? For every $1 of sale, the company makes about 18 cents. Yeah? Less, if it's rounded to the nearest percentage, then it becomes 18. That is equivalent to 18 cents, yeah, for every $1 of sales. Okay, net income is 18 cents for every $1 of sales. Yeah? So that's the proportion. Alright, now we move on to the next, yeah, the second ratio, profitability ratio. This is not a cost efficiency ratio, strictly speaking, yeah, but it's a profitability ratio. This is return on assets. So for this, we take return here always refers to profit, yeah, net income. So net income divided by total assets. Yeah, you can take this value. Yeah, total assets or total liabilities and equity mean the same thing. Yeah. So you take net income divided by 5606, 893 divided by 5606, you get 15.93%. Yeah. Note that. Yeah. So how do you interpret this? Okay, this reflects, again, this is proportion, percentage, given in percentage. So here net income is equivalent to 15.93%, yeah, slightly less than 16% of the company's total assets for the year. Yeah. Note that here the numerator is from income statement, but the denominator is from the balance sheet. Alright, so that's how you interpret that. Yeah? So for every $1 of assets used by the company makes 16 cents, yeah? Less than 16 cents of profit. Okay, now let's move on to the last ratio in this category, the fourth category, which is return on equity. Yeah? Now these two, they have short forms. Yeah? ROA is return on asset. Some books call this ROTA, yeah? Return on total assets. Okay, or sometimes called return on investment. Yeah? So ROI means return on the company's total investment. Yeah? So company's total investment will be total assets. Okay, so sometimes also called ROI. Yeah? So ROA, ROTA or ROI refers to return on assets. Now this one is ROE, yeah? Return on equity. The formula is net income divided by total equity. Yeah? Equity is here, 2768. So you divide that, you get this, yeah? 32.26%. Yeah? Again, this is in proportion, percentage. This means that net income, yeah, is equal to 32.26% of the company's equity for the year 2018. Yeah? So for every $1 of investment made by the shareholder, which is the equity, they get, yeah, or they make 32 cents. Yeah? For every $1, they make a profit of 32 cents. Yeah? Because this net income is attributable wholly to the shareholders. That's how you interpret this. ratio.